I want to now add observations from a bonus question I posed to Gemini about the AI sector, because they help clarify where current market pressure is concentrated. AI-related stocks currently show late-cycle traits that echo the dot-com period. Where the comparison breaks down is valuation quality. Unlike in 2000, today's market leaders are highly profitable, cash-generating businesses, which changes the risk profile. The more concerning parallel is revenue circularity. Large platforms are funding AI startups that then spend heavily on services from the same firms. That can inflate reported growth even while end-user demand is still forming. A similar feedback loop existed during the late 1990s telecom build-out, and when it broke, revenues fell quickly. Capital spending adds another layer of risk. AI infrastructure investment is being pulled forward aggressively out of fear of falling behind. This resembles the fiber optic overbuild of the late 90s. The infrastructure may eventually prove useful, but if adoption lags, spending cuts can ripple through the semiconductor and equipment supply chain. Finally, concentration. The market is more top-heavy today than at the dot-com peak. A small group of stocks dominates index performance, leaving even passive investors exposed to a single theme. If the AI trade cools, the same mechanics that amplified gains can accelerate declines. So the takeaway here is that the market is late cycle and fragile in specific ways, vulnerable to repricing, slower growth as excess investment is worked off, and crowded positioning. That context lines up with what we saw earlier in the downside probability tables. For a detailed breakdown, watch the full video on my channel.